Hi, good afternoon, or possibly, I guess, good morning, depending on where you're listening to today's webinar from. I want to thank you for coming to join our webinar today on strategies for investing in apartments. We have a special guest on today to share his expertise, his strategies, and certainly his background as well. In multifamily investing is something, again, that we've seen a lot at Advanta lately. So we like to try to bring some timely topics and certainly bring in some experts in the industry to talk to us and obviously help us learn and open up our eyes to some more investment opportunities here. Whether you're using a self-directed IRA or not, the education hopefully is going to be valuable to everyone who's listening. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now, if you're listening to this webinar for the first time. I've been doing primarily the last several years really focusing on the educational aspect of self-directed IRA accounts, making people aware of what's possible, what you can do with your IRA account outside of maybe the conventional brokerage firms and what they offer as far as mutual funds and CD investing. So my educational background, I am a licensed attorney. I do not do any legal work though for Advanta clients. I want to make sure that that's clear. And I'm going to start off the presentation really by just going through a few slides. I want to bring on our guest presenter here in a few minutes. Really the bulk of the presentation as we go today will be our guest presenter talking more about what he does and obviously giving some examples as well. Do want to issue a disclaimer. We at Advanta IRA, we do not provide any legal, tax, or investment advice, and we also do not endorse any products, and we're not affiliated with any other companies, including anyone who may have appears or have appeared on one of our webinars in the past. So a lot of times when you're dealing with self-directed IRAs, there are legal issues that come up. There are tax issues that come up, and we're more than happy to address those with you and kind of go over some scenarios. But we won't give advice in that area. We can always refer you to somebody, an attorney or a CPA perhaps, to give you that guidance and to give you that answer that you need. And again, especially when it comes to in particular investments, we act as a record keeper. It is up to each individual IRA owner when they're making an investment to decide if the investment is right for them and to do all of their due diligence in regards to that particular investment. Now, some of you on the call may not have heard of self-directed IRAs before. Maybe it's a new topic to you. Why haven't you heard of them before? I think the simple reason is that most IRA accounts, most people have an IRA, they have an old 401k with a bank, with a brokerage firm who's offering them limited investments, and they're not letting their clients know what other options are even out there. You can actually take this money and put it into real estate or put it into private loans or invest in a real estate syndication because they don't offer that product. So they don't want to let their clients know that there's other options out there. It's the same reason if you went into a McDonald's today, they're not going to let you know that there's a Taco Bell down the street in case you want something else for lunch. So the fact that most people just aren't searching for it and they're not being told by their current custodian, I think is the main reason why people have not heard of self-directed IRA accounts. Now, IRS regulations certainly allow for a much broader range of investments outside of the mutual fund, stocks, or CD accounts that most people associate with IRAs. Now, why do people choose to self-direct? I think there's three buckets most people fall into, or maybe they might fit into more than one bucket. For a lot of investors, a self-directed IRA is simply a new source of capital, the ability to take your funds and put it into investments that you already know, especially if people who are investing in real estate already know that that's a worthwhile investment. They've decided that that's their path. So the self-directed IRA is just providing them another way to fund their next real estate investment. A lot of clients are fatigued by the stock market, the ups and downs. The Dow is up big one day, it's down big the next day, and a lot of people just don't. It makes people uneasy. You're not comfortable with those investments, and you're looking for something else and looking for something more stable. And again, that's why a lot of clients, at least that we've dealt with over the years, have turned to real estate and other types of investments to really settle down their account, let them sleep a little easier at night. And for some clients, there's a tax benefit. The ability to, when you invest through your IRA account, the income that is generated comes back to your IRA, either tax-free or possibly tax-deferred, back in your IRA account, depending on the IRA that you have. So if I'm looking at making an investment when I'm going to have a lot of gain, I can defer that gain by making that investment through my IRA account. And again, use that newer source of capital. So again, it's a large, self-directed IRAs, anywhere from your doctors and attorneys and other professionals, all the way down to individuals who build up a large 401k or 403b as a public school employee, just are choosing to do something a little bit different with their IRA funds. Now, if you're someone listening to the webinar today, I think that's looking to raise capital, why are self-directed IRAs a good capital source? I think for raising, number one, it's easy to go to your existing investors and simply ask them, hey, are you looking, we have another project coming up. Here's another way that you can invest. So you're happy with how we've performed in the first investment, and going for the second one, here's just a different way to do it using their IRA account. So you don't necessarily have to go out and find brand new people each time to raise more capital. It's going to some of your existing clients and existing investors and showing them a different way to use their IRA and a different way, obviously, they could invest with you. Hopefully as well, if you're doing investments, you're probably going to offer them better returns. A lot of people have their money sitting in that 1 or 2% money market or CD account because they're afraid of the stock market, and they know that CD is not a good long-term solution, but they don't know what else to do with the funds. Obviously, investing with you, if you're giving them a consistent rate of return they feel comfortable with, that's another reason why I think people will look to do a self-directed IRA and ultimately, raise or lend their capital to you for an investment. Additionally, when people investing with IRAs, generally speaking, are not looking to use their monies within the next 5 or 10 years. So if you're doing an investment where you're projecting that that you're going to have some cash flow in a few years and you're not really going to be fully paid off for the next 10 years, your money will be locked up and illiquid. Individuals are more likely to use their IRA funds for that type of an investment because they understand and realize that I'm not touching this money anyway until I get to retirement. I don't want to use my savings account to make this investment because my savings account is my rainy day fund. If something happens in that next 5 to 10 years, that's where I'm going to pull money out. So if I lose my job or some of the life-changing events happen, they may not want to tie up their savings account. But the IRAs, the 401ks, a lot of times are the last place individuals will look when in times of those situations. So they don't mind locking up their money they weren't planning on touching anyway as well. Additionally, and the last thing, I think the reason why their IRAs are good capital sources, no outside approval needed. The IRA owner, the individual investor you're talking to, they simply make the decision to make the investment. They put wheels in motion, do the paperwork to get the process done. You don't have to go to some third party to get approval. Brokerage firms, a lot of times will try to look at an investment if someone's trying to make an investment through them, if it's outside of what they usually hold. And there's a lengthy approval process for doing so. And a lot of times the answer at the end of the day is no anyway. Self-directed IRA, the money is moved over. The client then is in charge of what they're looking to invest in. Now, the accounts that can be self-directed, any type of IRA, whether it's an individual, traditional, or Roth IRA, if you're a small business owner, SEPs and simple IRAs as well are tailored for you to put more money away in a given year. And then certainly we offer an individual K plan. Sometimes they're referred to as QRPs or qualified retirement plans. Individuals can, again, who are self-employed, can start their own solo 401k plan in order to, again, to sock away more money in a given year. The difference between the plans that are on this screen typically are how much you can contribute in a given year, but they can all have the same options as far as what you're looking to invest in. So if you have a traditional Roth, SEP IRA, a simple IRA, any old 401k, 403b plan from an employer, you can self-direct those funds. It's just simply a matter of moving those funds into a self-directed IRA by either doing a transfer or a direct rollover. It's just a different terminology used when you're moving funds from one account to another. Again, if you have an account currently in an IRA custodian, it would be a direct transfer. If you have money in an old 401k, it's considered a direct rollover. So it's, again, different terminology, a little bit different process. But the key thing to understand is that when you're moving money from those other accounts into a self-directed IRA, it is a non-taxable movement of funds. There are financial advisors out there who get confused at times. If you go to your advisor and say, I'm looking to use my IRA funds to invest in a real estate project, since they don't deal with real estate at their firm, they think you're taking the money out as a distribution and are going to subsequently pay tax on it. So they'll warn you and they'll scare you that you're going to have this big taxable event. But using a self-directed IRA allows you to keep that money tax protected. And instead of holding mutual funds in the account, you're simply holding real estate as the actual investment inside of the IRA itself. So the types of assets, real estate that we see, again, the focus of today's presentation is really more in the multifamily space and the apartments. But we do see people invest in single family homes, whether that's for rentals, whether it's a short-term rehab project. You can invest in private notes and mortgages, mobile homes, tax liens, etc. Again, the genesis of today's presentation really is to focus more on the multifamily side of things. That's what our guest presenter is on board to talk about today. Very simply, how does the process work if you're going to use your IRA account? In this particular quick case study, Jane has $100,000 in an account at Vanguard. She meets Randy. Randy is, again, going to be purchasing and remodeling an apartment complex and has an offering in order. He's raising capital from a number of different investors. And Randy provides Jane then with the subscription documents and his prospectus. Now, it's up to Jane to work with us to get the account opened and get the funds transferred. That's something that we will hold her hand and walk her through that process of getting the account open, getting the money transferred just by simply completing our paperwork to get that money moved over. We send a simple request to Vanguard to have that money transferred. Again, the funds come over completely tax-free in that particular transfer. Now, for the investment process itself, again, we will work with Jane to make sure documents get completed in the name of her IRA. So when you're using a self-directed IRA for an investment, your IRA account is actually the subscriber. It is not you as an individual, and we use our trust tax ID number, not the social of the actual of the IRA owner as well. And that's important, very, very important from a tax perspective, that all of the income that's being generated from that investment is coming back to the IRA. And so Jane does not want to have any tax repercussions from doing so. So we need to use our trust tax ID number and not her particular social. Now, again, it's important that when Jane is looking at these subscription documents, our role at Advanta will be to make sure that the titling and the tax ID number, that information is correct. But it is completely up to Jane to review the subscription documents, review the prospectus, decide that this investment ultimately is something she wants to do, and she will sign off that she has reviewed and approved all of the documents. And once she's done this and given us her approval, we will sign the documents on behalf of the IRA account and then send wire or send funds out of her IRA account to the private placement itself to hold the investment. Going forward, the gains simply come back into her IRA. Again, it's not taxable to her. And ultimately, when she exits the investment, the proceeds all will come back to her IRA with no tax consequence whatsoever. So why Advanta? Why people use us? Again, we don't have a lengthy approval process for the investment paperwork. We simply are looking to make sure documents are titled correctly. We have a lot of experience dealing with private placements, whether it's in the real estate space. We have a lot of startup companies that we've worked with over the years as well with their investors. And we try to present a streamlined process and a private account manager for all of the investors. If you're someone raising capital and you're going to have 3, 5, 10 investors, maybe 20 investors, we'll put all of those investors with the same account manager here at Advanta to make that process as easy and smooth as possible. We have flat administrative fees as well, and we have DocuSign capability as well with our paperwork. So kind of ran through that very quickly. One thing I wanted to mention, I do have a question or two that popped up in the chat box. And as we go through the presentation, if you have questions for either myself or for our guest host and presenter, please type those in. The first question says, are there some IRAs that will not let you invest outside of their offered programs? And the answer is absolutely. If you have an IRA account with an annuity company, or even the brokerage firms, they are going to only allow you to invest in typically the investments that they're selling. It doesn't mean you can't. I mean, the IRS rules will allow you to invest in anything that is not a collectible or is not life insurance. Those are the only two investments that are prohibited by the IRS. But each custodian, in this case, the brokerage firms and the annuity companies, a lot of times will limit you to only investing in what they offer. And that's allowed by the IRS. The IRS says that each custodian can decide what they're willing to hold. So that's why companies like Advanta exist to kind of hold these different assets inside of an IRA, because the brokerage firms and the banks simply aren't interested in holding it. Question, can in-laws rent from you? If your IRA owns real estate and you're renting it out, there are some disqualified persons that cannot invest or your IRA cannot transact with. Your in-laws, if it's your brother-in-law, sister-in-law, technically they're not disqualified. If it's your spouse's in-laws, technically, again, they're not disqualified. But if you're going to be dealing with those individuals, you want to make sure you're dealing with them on an arm's length basis. A lot of the people that we deal with simply stay away from family because it can simply be a little tricky. But there are some individuals, typically yourself, your spouse, your parents and grandparents, and your kids and grandkids, that are disqualified from being able to transact with your IRA account. Someone asked, would the process be different with the solo 401k? If you have your own 401k, you'll be signing the documents as trustee of the plan. And the titling would be in the name of your 401k and using your 401k plan tax ID. So it's a little bit different. And we offer a couple different solo Ks here at Advanta as well. So happy to take that question as well offline. And a couple other questions quickly coming in. I want to make sure we get to our guest presenter here in just a moment. Can I use funds in an IRA to loan money in overseas markets outside the U.S.? Yes, there is no restriction, geographical restriction on where you can invest your IRA funds. Again, the restriction would be making sure you're lending money to an individual who's not disqualified. And again, the disqualified persons are yourself, your spouse, your parents and grandparents, and any businesses that you own or control. Is there any rules about using your own funds? If I use my own funds to buy a real estate asset that I manage, again, if you're buying real estate that your IRA is going to own, we allow you to manage it from the standpoint of deciding what you can and putting your tenants in place, deciding what work needs to be done on a property, but you can't be paid for it and you can't do the work yourself. So there are a couple of tricky rules. Again, that's a question probably involves a little bit more back and forth and exactly what you mean by the term manage. Can you transfer funds from an active 401k? That is going to be ultimately decided by your 401k company. So going back to that one slide I had, it is only for typically former 401ks, 403bs. There's no issue at all with moving those. If you were involved in a current 401k, they can restrict your ability to move those funds. So you'd have to check with your current 401k provider to see if that is an option. So what I want to do, let's say the last one I'll answer, and we'll get on to our guest host. What is a max contribution to an Advanta IRA, and can I own multiple accounts? Yes, you can have multiple accounts. That's not a problem. The IRS only limits you to how much you can contribute in new money in a given year from your IRA account. For a traditional and Roth, that for 2019, that number is $6,000 and $7,000 is the maximum that you can contribute across all of your IRAs. But you can have multiple IRAs and you can transfer money that's already in an IRA account back and forth. So there is no issue if you have an IRA existing that has a couple $100,000, you can move that money around as often and whenever you'd like. If you're putting new money into the plan, you're limited to that $6,000 or $7,000. All right, well, this time we have some great questions. I'd encourage you guys to continue asking. But this time I want to bring in our guest host, Dan Handford of Handford Capital. I met Dan actually a few months ago at a multifamily conference and thought he would be a great person to come in and use his expertise and his basically past experiences to really share some guidance on multifamily investing. Again, it's something we're seeing so much more of. I thought Dan would be a great person to come in. I know Dan does a lot of his own educational events as well with the Multifamily Investor Nation. So Dan, I want to bring you on. How are you doing today?
Doing very well, Scott. Thanks for having me.
Good. Sorry about that. It took a little bit longer than maybe I thought. We had some great questions. And like I said, I'll encourage people to continue asking questions as we go. And Dan, I might pop in every now and then with some of those that come up. But at this point, I'll turn the slides over to you.
All right. Sounds great. Well, again, thank you so much, Scott, for having me. Looking forward to sharing with you and as well as everybody who is part of Advanta IRA and on this webinar about multifamily real estate and why I got into it and why I like it so much. I'm going to go over a couple of things with it on this particular webinar. We're going to go over some of the reasons why I like multifamily from various points. And then I'm also going to go over some statistics around multifamily, and then I'm going to also go over a case study that we closed on in December of 2018. So last December, so that you guys can kind of see how these different, private placements might look and various things like that. I'm also going to cover some things about what are some criteria that you should look for, as a passive investor in some of these opportunities to make sure that you're selecting the right, offerings before you just jump in and start to invest some of your IRA money. And so, first off, I want to have you, so obviously on the screen here, you see it says passiveinvesting.com, right? So I like passive investments, and I know a lot of our investors like passive investments, of course. And so, but one of the things I don't like is I don't like a passive webinar. Okay. So right now, if you can go ahead and make sure you, in the chat box, type in there where you're located and your names. I'd love to be able to see who's on here, where you're located, to kind of have an idea as to where everybody is. So I'm right now located in Columbia, South Carolina, and I am sitting in my office over here right off of, if you've ever driven through Columbia, going to Charleston, South Carolina, so I'm not that far off the interstate. My office here, it's a little executive office that we have for the multifamily investor nation, as well as our passiveinvesting.com group. So I'm not seeing, Scott, any of the stuff coming into the chat box. Is that because of how they're sending it, or?
Yeah, actually, they're sending it through the questions. So yeah, I see there's people. There's someone from Atlanta, San Antonio, West Palm Beach, somebody else from Atlanta, California, Columbus, Ohio, Tampa, Palm Bay, Florida, Northern Nevada, Utah, Maryland, Sarasota, Florida, Charlotte, North Carolina. Someone said not too far from where Dan
Awesome.
is. So yeah, a number of people from Atlanta and Georgia. Obviously, that's where we have a lot of our, Dan's, a lot of our clients are based in either Tampa Bay or Atlanta. So we're probably a little heavier on the Atlanta and Tampa market and the Florida markets. But yeah, it looks like we got a lot of people all over the country.
Awesome. Well, I thank every one of you for being here. I'm going to jump right in because I know we don't have a lot of time, and we have a hard stop right here at 1 o'clock Eastern. So let's go ahead and dive in here, and first just kind of give you a little bit of a background about myself. So I am the key principal and partner of passiveinvesting.com. I have two other partners in my group here, Danny Randazzo and Brandon Abbott. And I'm the owner of 5 specialty medical clinics here in South Carolina. And I'll get into that's one of the reasons why I like multifamily, is because of those clinics. And I'll get into that in a little bit. But they're non-surgical orthopedic clinics. We do a lot of regenerative medicine, prolotherapy, PRP, stem cell, that kind of thing. And we also do some sports medicine there too. We have three medical doctors and almost 50 employees, 5 nurse practitioners that work for us here. And we have one here in Columbia, South Carolina, one in Greenville, Charleston, North Augusta, and Fort Mill. So we're kind of all over the state. And moving into 2019, we're looking to open up 2 more, one in the Hilton Head market, as well as the Myrtle Beach market. So that right now, I have I'm the president of the organization, and I own them 100%, but I have a team behind me that manages and runs everything from the day to day. So I'm focused full time on the multifamily investing side of things right now. But I still do see financial reports that come through my desk every Monday morning from various departments, so I can have a 30,000-foot view of things. And I also have a corporate director meeting every month as well. And that's actually tomorrow for about 4 hours. So I have a 4-hour meeting because we didn't do one in December. So we're going to spend a little bit more time with that this month. I also have investments in over $125.3 million worth of multifamily real estate, a portfolio that consists of a little over 1,300 doors. And I'm also the founder, like Scott said, of the Multifamily Investor Nation. And we do some regular, usually weekly, and then we're going to probably do some bi-weekly educational webinars. And so we've been doing that for several months now, and we have over 3,000 members. There's no charge to join, but we have a closed Facebook group that we talk all about multifamily and share a lot of things that we're working on and doing. You can join and sign up for our email list by just going to multifamilyinvestornation.com. And when you go there, just type in your email. You can join us there. There's also links there to join our closed Facebook group if you'd like. And my wife and I also host a podcast called Tough Decisions for Entrepreneurs. So we have a podcast that we invite high-level entrepreneurs on to talk to us about various tough decisions that they've had to make along their journey of success, whether they be good outcomes or bad outcomes. And you can find more about that by going to toughdecisions.net. So I wanted to kind of give you a little bit about my family as well, because I know sometimes we have webinars and it's very hard to duplicate the one-on-one in-person sessions. And so the best thing I can think of is to share with you a little bit about my family. And so on the top of your screen there on the right hand side is my wife and I at a baseball game. In the middle of the screen there, you can see my son. He is 6 years old. I have 4 children, so he's my second child. On the left is our daughter, Callie. She's our youngest, and today is her birthday. So she just turned 1 year old today, so we're really excited about that. And then in the bottom left-hand corner, you can see us actually at the Mall of America in Minneapolis, Minnesota. That's one of those drop ones where they bring you all the way up and just drop you straight down. The kids love that. And we go there at least once a year, sometimes twice, just to enjoy the indoor theme park, if you will. But just to my right there, as you're looking at me, is our oldest daughter. She is 8 years old now. Don't want to get that wrong. And then to the right, you can see our third child, Chloe. And if you look closely, you can kind of see what she's looking at. But she is actually in the back seat of my car, and she is looking at the Jacksonville multifamily market overview. So I had met with some brokers, not with her there, but I met with some brokers a couple of days prior to that in the Jacksonville market, and they had given me a really nice brochure on the market in Jacksonville, and that's her looking through it, keeping herself busy as we're driving down the road. So I'm sure we were probably on the way to pick up the kids from school or something like that. So that's a little bit about my family. So let me dive right into why invest in multifamily real estate, because I think there are some things that people don't really understand. What are the major benefits of it? Obviously, some of the benefits change when you're investing out of an IRA, but these investments are not just for IRAs. So even if you have an IRA and you want to do some of these types of investments, they're a really good vehicle to help to kind of increase the value of what's in the IRA. But it's also good for somebody who doesn't have money all in their IRA and they have money that's some cash sitting around, or maybe it's in the stock market or something like that, and they're worried about the upcoming crash or correction or whatever is coming. Nobody really knows. I've actually done some research on that. We've been talking about this correction, if you will, since 2015. So some experts are saying it's coming this year, but they were also saying it was coming last year, those same experts. So obviously they're going to be right one of these days. And so it just takes time to be able to get to that point. It is one of the most recession-proof investments. And the reason why I say that is because if you look back at the default rates back in 2008 with the single-family residences and just any other asset class outside of multifamily, most asset classes were seeing about a 4% default rate, which you might think is low across the board, but that's actually pretty high. And so when you look at the multifamily market, though, in 2008, when we had the crash, it was 0.4%. So when you talk about a stable asset, this is a recession-proof investment. This is a stable asset. And the reason why is because whenever the market is doing really well, people are renting and wanting, and because the market is growing, people are renting. There's families that are growing, children are going out of the house and need a place to rent, and so they rent, right? But also when the market starts to go down, people are unable to actually get loans for their houses, and so what do? They end up renting. And so there's 3 asset classes, or one's not really an asset class, one's just a product, but there's 3 things that really do well in a good economy and a bad economy. The first one I always say is multifamily. The second, for those reasons that I just said. The second is self-storage, because usually when people are, in a good economy buying a bunch of stuff, they need a place to store all their junk, right? And then in a bad economy, people are downsizing and trying to store their stuff so they don't lose it. So it's usually a really good asset class to investigate as well when you're talking about investing through your IRA. The third one, though, is one you probably aren't even thinking about. It's not an asset class. It's not real estate, but it's a product. So there's 3 things: multifamily, self-storage, and the third one is alcohol. So, and I think you know what I mean. In a good economy, it's doing really well. In a bad economy, people are still drinking, right? So those are 3 things that are really good. I don't know if you can really invest with your IRA in alcohol, but I'm sure there's probably some opportunities out there for some I don't know what they call them, but some wineries or something that you could invest in. But
I was gonna say, Dan, we've had some people invest in like microbreweries, people who are starting up a new beer label, whatever, and they're looking for capital. Yep.
Yeah. So now that just confirms it even more, Scott. Well, one of the things like that has to do with, being recession proof is that there's also capital preservation, because that's really the key thing here is, when you start to invest in, the stock market, whether it be stocks, mutual funds, annuities, REITs, whatever it is, there is that extra risk, that higher risk of when the market starts to turn, if you don't get out fast enough, that it could that amount of that IRA or that investment or whatever, could go down. And so a lot of people have talked about that back in 2008, that overnight, all of a sudden they went from, six figures to, very little left in their accounts. And that's what a lot of people, I think, are worried about right now is that capital preservation. And when you're investing in a recession proof, asset class, that's one of the things that you do have is that capital preservation. And of course, the potential doubling of your self-directed IRA or any type of an investment on a 5-year hold period. And that's typically what we see. And I'll go over our criteria that our group looks for and what you should be looking for when you're looking at other operators. So this webinar is not all about you trying to use me to invest with me and my group. Obviously, I'm looking for other people that are interested in investing with us. On your screen, you can see passiveinvesting.com. You can go there. There's a one-page form that's easy to fill out. So if you wanted to jump on a call with me and discuss these further, I'd be glad to do that. And you can fill out that form, and I will do that with you. But I also want to give you some criteria so that when you're looking at other offerings, what you should be looking for. And we're going to go over some underwriting tips as well on some high-level things that, as a passive investor, you should be looking for when you're actually vetting a deal and vetting a sponsor. So obviously this is passive income, even obviously with your IRA, it's passive income for your IRA, but it's passive because you're not having to do anything. You're not having to manage the toilets and the tenants and, all this other kind of stuff that's going on with properties. I had one of our properties, I had a phone call this morning that their phone lines are out. So I got to figure out, what's going on with the phone line. So that's the kind of stuff that you guys don't have to mess with and you don't have to worry about as a passive investor. You just get your monthly distributions, and we'll talk about the distributions as well. And then the final reason why I like multifamily, which is the main reason why I got into it to begin with, is the tax benefits. So we have depreciation, right? So we have 3 different types of depreciation that I like to focus on. First is standard depreciation, and then we have accelerated depreciation, and then we have bonus depreciation. So these depreciations obviously aren't going to benefit you as much in an IRA setting because you're already getting the advantages from the tax savings of being in an IRA, a non-taxable IRA. But I'm going to go over these because some of you probably have some money that are outside of your IRA that you might want to invest as well. And so being able to take an income off of a property, because we do monthly distributions on our deals, so you have that monthly cash flow. We want to make sure that there's a lot of depreciation on that. And so obviously you have your standard depreciation, which is going to be taken out over a 27.5-year period of time. You can take that asset, no matter what asset class it is, except for commercials, a little bit more than that's like 39 years. But this one, even though it's considered commercial for a lot of people talk about, multifamily is taxed on the residential level. And so we can depreciate this under a standard depreciation schedule of 27.5 years. And so our group has minimum criteria that we look for in an asset. So we want minimum $10 million purchase price, and we want minimum of 100 units or more. And so the reason why we have those minimums is because we want to make sure we take the best advantage of the accelerated depreciation as well as the bonus depreciation. So the accelerated depreciation is where you can hire an outside engineer firm to come into the property and piecemeal it down and figure out, and start to depreciate accelerated. They break down the property to like the flooring and the shingles and the sheetrock and the studs and the doorknobs and the light fixtures and the cabinets and the appliances, and they break the property down into different classes so that you can accelerate depreciation based on the items within the property. And so now, instead of waiting 27.5 years to depreciate the entire property, some of the items within the property, we can now accelerate that to 5 to 15 years, depending on what item it is. And so according to the IRS rules, we have to hire an outside engineer firm to do that, to have that all verified. And so that costs money, which is why we want to make sure we have enough property value to be able to support paying the amount of money that it takes to do that. And then bonus depreciation is where you can, Trump, I'm trying to think about where I'm going to go here. So Trump actually enacted his new tax law back in 2017, which allowed us to be able to expense 100% on some of the items that we used during the renovations. And so when you have a lot of renovations, you can now expense that 100% year one instead of having to depreciate that over a normal depreciation schedule, which is usually 5 to 15 years, depending on the item. And so that's an additional bonus that we get on top of it. And so imagine being able to invest in a vehicle like this, get cash flow off of it month after month, and then at the end of the year show a loss, so you're not having to pay taxes on that. Now obviously there's some recapture tax that occurs once you sell the property, and so there's some other considerations there. Obviously in an IRA setting you wouldn't have to worry about that piece of it, because you're already taking advantage of that when you're moving it into that kind of a vehicle.
Dan,
So
we
this
had a
is
quick,
just
if I
sure.
can, let me just give you a quick question. Actually, maybe you're getting a little bit into the returns, but somebody asked, no guarantee, but what is the typical range of distribution percentages? That's something you're going to cover. I'll just leave you be. That's a question we
Yep.
just had pop up, though.
Yeah, so I will answer that in a couple of slides here. So we're getting ready to get to
Okay.
that piece. So just hang tight for just a couple minutes. So this right here is a graph showing you the historical risk on return on stocks and bonds versus real estate. So it's just real estate in general, but you can see that that real estate has had lower amount of down years and a lot more of your up years. And so this is just kind of another graph to kind of show you why investing in real estate, whether it be multifamily or whatever type of asset class in real estate, is a good idea. The next thing is with multifamily is that home ownership since 2005 has really started to drop. And you can see that dramatically in this graph here from 2005 to 2017. Home ownership has been significantly dropping year over year. And you can also see that here that we are becoming a renter nation. So a lot of your millennials and a lot of your younger families now, instead of putting money and locking it up into a house, what we would normally think of as a dream home, they're now starting to rent. And you can see that dramatically here since 2002. The actual renter nation, if you will, has gone dramatically up, and it's just going to continue to climb. We're actually going to be in a shortage. There's a website called weareapartments.org, and you can look up several different of the larger markets and see that between now and 2030, we're going to have a significant six-figure plus significant shortage between now and 2030 unless we start to build more apartment units. And so now you get into this supply and demand issue, which just raises the rents and raises the evaluation of a property, which again increases the returns for investors. And so this is the typical process that our group goes through. I'm not going to focus too much on this because it's a pretty straightforward piece. I know there's a lot of words, but basically on the left-hand side, you'll see it says sourcing. So we are sourcing deals every day, and we focus on the Southeastern markets as well as the Texas markets. And so we might look at 100 deals before we get to the point of going, yes, let's go ahead and fully underwrite that deal. Of those 100, we'll underwrite 30 of them. Of those 30, we'll submit offers and get accepted on 10 of them. And then we will get, we'll underwrite 30, and then we'll submit offers on 10 of those. And of those 10, we'll get one deal out of them. And so there's a lot of work in this process to make sure we find the right investment for our investors. And we make sure that because I'm an investor first, our group invests alongside each one of our investors. So remember, if you remember why I got into real estate, it's for the tax advantages of it. And so that's one of the reasons why I'm also investing in these deals, is because I want to be able to put this and use this as an investment vehicle for my group. I mean, for myself personally as well. So this is just a quick overview. We're going to go into the criteria a little bit more as we move forward, but minimum unit count is around 100, 150 there. You can see usually the loan to value ratio that we're getting is between 65 to 75, which is a little bit lower than you might have expected, because I know some groups do 80, 85, and that's fine if you want to do that. Our group feels like moving into a softening of the market. We want to make sure we have a lower LTV so we're not over leveraged, and so we do that. Typically, we have annual returns of 8% or more. Our targets for IRR, which I know some of you listening might not know what IRR is, and I'm going to go over that in another slide, so just hang with me. But we're looking at between about a 15 to 18% IRR target, and that range depends on the risk profile of the investment. So the lower the class property with a lot more value add component to it has a lot of higher risk to it, and so that higher risk would warrant having a lot higher reward at the same time, so a higher IRR. An investment that might not necessarily be as risky, then you're going to see it's going to have a lower return to it. So it just depends on the type of vehicle that we're using on that particular investment. And typically we're holding these assets for 5 to 7 years. Occasionally we might do 10 years, but most of the time it's 5 or 7 years, and it all depends on the actual business plan. So you are locking the money up for that period of time, but you're also cash flowing off of it. All right, let's see here. I'm going to go to another slide because I don't know why that other one got in there. All right. So internal rate of return, I want to talk about that first because there's some misconception that you might be thinking of as far as internal rate of return, or you may have never heard of it before. And so the internal rate of return, I like to kind of think of this as your ROI, but not your ROI. So let me explain. So if somebody comes up to you and they tell you that they put $100,000 into an investment and they got $200,000 out of it, is that a good investment? And you might be thinking, well, yeah, I mean, I doubled my money. But what if they didn't tell you how long it took them? Now, if it took them 5 years, that might be a really good investment. But if it took them 20 years to do that, that's not a very good investment. So you can't just look at ROI when you're talking about these types of investments. You have to look at the time component that's involved with how long your capital is being held up and how long it takes you to return or recoup that. And that's the IRR. It's the internal rate of return. And so you want to make sure that you're always looking at that internal rate of return. And it basically kind of annualizes and kind of stabilizes or allows you to see an annual look at what are you actually getting for the amount of money that you're investing in and how long they're actually holding on to your capital, which is why in most of these investments, you'll see the investment is for a 5 to 7 year time period, 10 years max, because the longer we hold on to your money, then the lower that IRR is. And we want to make sure that that IRR stays at a certain point. And there's also other things to consider that, we talked about the accelerated depreciation, being able to accelerate things to 5 years. Well, once we've hit that 5-year accelerated depreciation, now the depreciation is going to go down after year 5. And so there's some additional tax consequences that we have to consider as well in these investments. Cash on cash is a fairly simple and pretty straightforward. Cash on cash is you put $100,000 into a deal. If you get 10% cash on cash, that means you're getting in $10,000 a year off of that investment. So that's that cash on cash return on the initial equity or initial investment that you're putting onto a deal. So keep that in mind when you're considering an investment. On ours, our typical cash on cash is about 10%. So we typically do anywhere between a 6 to 8% preferred return. So on an 8% preferred return, you're going to get at least $8,000 a year off of those investments, as long as it's putting out that cash flow, which most of our investments we try to get to that point at a very minimum. But on a 5-year hold, if you annualize it out, it's typically about about 9 to 11%, so about 10% on average. The cap rate is the capitalization rate, and that is a market-specific number that allows us to know where are these types of assets trading at. And so what you might not know is that in multifamily, the way they value these is not by looking and seeing which ones have sold around the property like you might see with a single-family home, and they value the property based on other sales comps. They value it based on the actual market cap rate. Now, again, that market cap rate is set based on some of the other properties that have traded, but every property has a little bit different when it comes to amenities and asset class and various things like that. So I'm not going to get into that very much right now because that's a more detailed webinar. But the capitalization rate allows us to value that property. Okay. The debt service is your mortgage payment, including your principal and interest. And so when you're looking at your debt service, you have your cash flow, which is your income and your expenses taken off. You take your expenses out of your income, and that's your cash flow. And then you have or your net operating income, and your net operating income, you take out your debt service, and that's the leftover amount is going to be your cash flow. And so one of the things that lenders look for, and we always look for, is to hit a certain threshold or certain number when you get to your debt service. So obviously when you're using a bridge loan, these debt service coverage ratios will change, and the debt service coverage ratio allows us to know how much of your net operating income are you spending on your debt service. So let's say you have net operating income of $100,000 and you're spending $100,000 for your principal and your interest, you would have a 1 debt service coverage ratio. That means you have just enough to cover your mortgage payment and interest and no cash flow after that, which means that you don't have any money to return back to investors on a regular basis. Now, obviously, that might fluctuate and change, but that's just to give you an idea as to how that's calculated. We want to see typically about, and we want it to be over 1 so we can return cash flow. We want to see around 1.25 to 1.35, somewhere around in there throughout the life of the whole of that property. And so you want to make sure you're always looking at that. When you're doing a bridge loan, a lot of times it can dip below the 1 because of, having some interest only stuff in there, but also, some capex and some occupancy issues and various things like that hopefully will be corrected, the first year, and that number will go back up. But a lot of lenders want to see a minimum there. And that's one of the reasons why bridge loans are used in this type of an asset. Another nice thing about real investing in this type of multifamily is, sometimes, investors will call me up and they'll say, well, I'm a little bit worried about investing because I don't have any control over what happens. Like what if I put money and I invest in this and I'm an owner in the property and then something happens, somebody gets sued or something happens on the property. Am I going to be liable for what happens on the property, or what happens if, the bank comes in and there's a default on the loan? Are they going to come after me personally? And the answer to that is no. So they're not going to. You would be considered a limited partner, and so you are protected. And the only thing you have at risk is your initial investment. And so the initial investment is protected because, as far as from like lawsuits or things happening on the property, we have lots of insurance. And so we have a lot of insurance on each one of our properties, but we also have umbrella insurance policies on top of that. And the lenders require that. So it's not something that, we're just kind of not going to do on some properties and do it on the other ones. All of them are requiring this. And it's a smart thing because we don't want to be held liable either personally if somebody slips and falls and there's a lawsuit and things like that. So you're protected from that standpoint, and you're also protected from the debt being defaulted on as well, because this is non-recourse. You're not signing on the loan. There's other guarantors on the loan. Myself and our other partners are guarantors on the loan. And even though it's non-recourse, there's still bad boy carve-outs, which is why we have to sign on the loan.
Hey, Dan, quick question just popped up. Someone asked if you use HUD loans or not in what you're doing.
No, we do not.
Do not. Okay.
No.
Another quick question, if I can interrupt just for a moment. Somebody asked what the minimum investment, what are the, what you're purchasing, what's the term? I know you said typically 5 to 7 years. Do you have a minimum investment you take from investors?
Sure. So the minimum investment in most of our deals is $50,000. Some deals, depending on the business plan and the model on it, it might be $100,000, but anywhere between 50 to 100 is where we usually keep the minimum on each one of our deals. So,
and I'm assuming those individuals for most of the time need to be an accredited investor.
So it depends on the deal. So I would say it's kind of 50-50 with our group. Some of our deals we do open it up and do what's called a 506B registration, which allows us to accept some sophisticated investors. And so we do open that up on some of our offerings, and then some of them it's accredited only. And so you do have to be an accredited investor in order to invest in some of those offerings.
Okay.
So good question there. I'm going to go over some of the criteria that we look at as well. So our group is typically looking at a vintage of anywhere between 1980 to 2005 construction, give or take a few years there. There's some reasons why we don't want older properties because of some other, considerations about asbestos and wiring issues and plumbing and stuff like that. So we want to try to find in our sweet spot of 1980 to 2005. And then we also want to have a cash on cash, like I talked about, of approximately 10% on that 5 to 7 year hold. And then and the IRR piece we want to have there as well, between 15 to 18%. And of course, that equity multiple we want to have there at a 2x. And then there's two things that I really want you guys to focus on. So these are some criteria that we use, which I think are great, solid, conservative criteria to look at. But one of the things when you're looking at underwriting for other deals that you're looking at possibly investing some of your money on, you want to make sure that you're focusing on that entry and exit cap rate, because where they really more the exit cap rate than the entry, because if they enter at a certain cap rate, you want to make sure that they have some sort of a spread of at least 50 to 100 basis between, the entry and the exit cap rate, because that cap rate's a percentage. So if they come in at a 5% cap rate and when they exit the property 5 years later, it's always good to see, as in conservative underwriting, at least a 50 to 100, if not more, spread on that entry, between the entry and the exit cap rate. Otherwise, they're basically projecting that you're going to get a 15 to 18%, and they're going to enter and exit at the same cap rate, which would be a phenomenal deal. And sometimes that does happen. But when you're underwriting and modeling and being conservative with your projections, it's always best to have that spread. So make sure you look at that and see what's the entry, what's the exit. Do they have at least a 50 to 100 a percentage point or basis point spread between that? So between about a 0.5% and a 1% spread. So if they came in at 5, you want to see them at 5.5 or 6 on that spread. And the next thing here is to also know your sponsor, right? Know the sponsor that you're dealing with. Can they execute a business plan? One of the things that's really nice about our group is that we have a solid group of Danny Randazzo being our financial analyst. He works for a top financial analyst firm, and he is a top financial analyst for them, and he works on all of our due diligence. At any moment in time, I could call him up, and he knows the occupancy level of all of our properties, because he's looking at it every single day and making sure he's monitoring that to make sure if we need to shift or change something, we can. But also myself, I have a background of managing large budgets with our medical clinics, over $10 million budget, annually, that I'm looking at and managing on a regular basis. And so we have the ability to manage a large budget, but also these assets, which makes it really good. So just make sure that when you invest in a sponsor, that they have a track record and some sort of business or success, and they know that they can fulfill and complete and implement a plan. And they also have the ability to invest alongside you in each one of your properties. So we have about 10 minutes left here. So I'm going to go through an offering memorandum that we put out on a deal that we just recently closed in December. It's called Hampton Forest. It's in the Greenville, South Carolina market. And we have, this offering is not available. So don't email me and ask me for this. It was a very, very good investment, and our investors are going to be very happy with this one. But I just want to show this to you to give you an example of what we would actually be putting out. So first off, I want to point out here the cap rate. And so the cap rate on this one, we're seeing at 5.27%. And this is a slide from a 30-page PDF presenting to our investors this particular opportunity. Okay. So I just selected a few slides that can kind of help you understand how we do things. And so on this particular project, it was a 5.27% entry cap rate based on a T12, tax adjusted T12. Okay. And what that means, tax adjusted, is if we can figure out what we're going to be paying on taxes when we buy the property, because in South Carolina, every market's a little different, but in South Carolina, they get reassessed whenever there's a trading of properties as well. And so we always adjust that based on that. So we have that 5.27%. You can see the reversion cap rate, which is that exit cap rate, at 5.95. And so we do have that 50 basis spread in that between that entry and exit cap rate. Now, if we exit this deal at the same entry cap rate, the returns are going to be even better than what we're projecting. And it's very possible on this asset that we'll be able to do that, but we're not going to underwrite it that way. The expense ratio, you can see here at 49%, and you want to typically see that around 50%. So the smaller the number of units, that expense ratio might go a little bit down or up. But typically when you're in 100 plus units or more, it's around 50%. So you want to kind of monitor that. If you start to see one that's 150 units and you see like 25 or 30% expenses, something's probably off, So you want to make sure you look into that underwriting a little bit more, paying a little bit more closer attention to that entry and the exit on the projections on the expenses. The DSCR, that debt service coverage ratio there, you can see at 1.53. So it's a very, very healthy debt service coverage ratio. And that allows us to have a lot more cash flow after we've paid the mortgage and the interest. Purchase price on this one was 8.9 million. And the hold time on this one was a 5-year hold. And then we also had the equity requirement of about 2.43 million. The equity multiple, 2.33. And what that is showing you is if you put $100,000 into this deal, 5 years later, it'll be $233,000, including the cash flows and the exit. And of course, the average annual return, that cash on cash, 10.3. The average annual return, if you include the proceeds of the sale, 26.6%. And then the IRR on this one, because it was a lower class that we're repositioning, heavy $13,000 a deal lift, $13,000 a door lift, it was going to get that upwards to 20.8% return on that. So a great deal. Really liked it a lot. You can see here just some more of the executive summary showing year over year, 8% year one, then 10, 10, 11. And then of course, year five, because it includes the proceeds at sale, it jumps to 185. And what it would do there if you put in $100,000. So I want to try to get to some of your questions. So I'm just going to go through some of this. Typically, our partnership structure is about an 8% preferred return to investors, and then we do a 70-30 split, 70-30% split thereafter, 70% to investors, 30% to the sponsorship. You also will see the membership ownership is 70% up to an IRR, an 18% IRR, and then 50-50 thereafter. So once we hit that threshold of 18% IRR, that the split goes from 70-30 to 50-50. So it's what they call a secondary hurdle. That might sound confusing, but feel free to go to passiveinvesting.com, fill out that form, and I'll jump on a call with you if you want to have a little more explanation, a little more detail. I can send you some more of these examples so you can kind of see this. So this is just another slide out of there. And I know it might be a little bit hard to read, but hopefully on the replay, you can maybe stop it and kind of read through this. But this just kind of is an example of what we show to investors about what we're doing on the property. What's the plan for the property? What are we doing from a loan standpoint and the exit strategy and various things like that. So just to kind of recap real quick, the reasons why we want to invest in multifamily: capital preservation due to recession-proof investments, potential doubling of your investment over that 5 to 7 year hold period, passive income, even for your non-IRA cash, and then also for your tax benefits as well. So I have about 5 minutes here. I know I kind of ran through that pretty quickly. So any questions that have come through?
Yeah, Dan, a couple. One of them, we're going back to, I mentioned the accredited investor. Someone asked if they are they as an individual are accredited, does that automatically make their spouse accredited?
If they are married, yes.
Okay. Another question: do you ever get involved in self-storage facilities?
Our group does not. We don't do any self-storage. We're primarily focused on the multifamily space because we want to make sure that if you are interested in self-storage, shoot me an email. You can email me as well, and I'll be glad to give you some information on somebody else that I know who does self-storage. It can maybe direct you in a better way. But you can shoot me over an email. It's just dan@multifamilyinvestornation.com, or it might be easier just to do dan@passiveinvesting.com. So either one of those goes straight to me.
I had a couple of people ask during the webinar today too, and I can answer this one. It was, are they going to have the ability to listen again? And Dan, you just mentioned it a minute ago. We did record this webinar. Everyone that's logged in live is going to get an email of the recording in a day or so. So you will get that presentation.
Awesome.
You mentioned as well, you do a lot of investments really focusing in the Southeast, or I guess in Texas. Are there any areas of the country you kind of, when somebody brings a deal or you see a deal, like absolutely not because of where that's located?
Yes, I do. So I try to stay in markets that are I'm one that I'm familiar with, and so but I also want to have markets that are poised for growth. We want to have markets that have an influx of population. So I'm not investing in any markets that are having a lot of a migration away from them. But if you look at some of the southeastern markets, whether it be South Carolina, Florida, Georgia, North Carolina, all of those markets, and even Tennessee, you're seeing a lot of migration, northern migration from the northern states down to that southeastern markets. And same thing in Texas. And one of the things that attracts a lot of people to Texas and Florida is the no state income tax. And so there's a lot of advantages for that. But I don't invest. I also want to invest in areas that are landlord friendly. So markets like New York and New Jersey and California and some of the other western and northern states, they're not very landlord friendly. So it's hard to kick a tenant out if they're not paying. And so it really affects cash flow when you have people that are in a property that you can't get rid of them because there's a long legal process to get them out. And so you want to make sure you look at that as well. And so that's one of the reasons why we kind of stay in those southeastern markets, because most of them are usually pretty landlord friendly.
Right, yeah, we got time for another question or two, and we have more questions that we're going to get to. So just want to let everyone know on the webinar, just reach out to Dan, reach out to myself if it's an IRA question, and we'll make sure we get those questions answered. But a couple more just quickly. Do you pay the returns paid out monthly or annually?
So I am an investor first, like I said, and I like monthly cash flow. And so we in our group distribute monthly. And so every month you'll get a prorated amount for that preferred return for that year. And then at the end of the year, we will distribute any more excess cash flow that we can.
And if someone's investing, do they get a K1? They get a K1 every year, correct? Someone's asking if they get one every year or just the first year when the deal
Every year you'll
closes.
get a
Yep.
K1. Yep. Every year you'll get a K1.
Yep. Or if you're investing with your IRA, that K1 will be issued again to the tax ID for your IRA. We get those every
Right.
year about this time. We start getting them in left and right. So, so again, Dan, I want to thank you again for your time today. Again, if you have other questions, someone did ask one other thing. If you can share again the link for your Facebook group or way to, you go to passiveinvesting.com. Can they access it there?
So you can't access it there. That's just the form to fill out if you're interested in possibly jumping on a call with me or being one of our passive investors. But you can go to multifamilyinvestornation.com. So just multifamilyinvestornation.com. Just spell all that out. No spaces, all one word. And there you can sign up for our email list. But there's also a link to our Facebook group there as well. So you can join the conversation there too.
All right, good deal. I'm going to jump back and grab the slides here. Again, I want to thank everybody for the pretending today. Dan, thank you again for your time. I'd love to have you back, or maybe when you have, we can delve into some other topics.
Sure, we'd love to. Thank you so much, Scott, and I appreciate everybody's attentiveness.
Okay, thank you very much, Dan. Again, anyone who's listening, appreciate it. If you're listening to the recorded version, either reach out to Dan or myself, and we're more than happy to answer any additional questions that you have, either on the multifamily space or self-directed IRAs. So again, thank everybody for attending, and we'll look forward to talking with you.